Today, what I'm going to talk to you guys about is assumptions. Now, with the current market trends, assumptions have become way more popular than they were during the pandemic. What has caused this popularity? Rise in interest rates, stabilized home prices. In some markets, you have some falling home prices, but it's still, with the interest rates at 6.5 to 7.5%, has prevented some consumers from being able to purchase a home. So if you take a listing and you're able to identify that the interest rate is, let's say it's under 5%, or for example, that might make it something to where you could also find another avenue to sell this property called the assumption. Okay, so one of the first things that you want to figure out when you are going to take a listing and you have found that the interest rate is low enough and you think that selling it on assumption is a good idea to kind of help market the property, what you want to do is you want to find out what the loan balance is, you want to find out what the mortgage payment is, you want to find out what the interest rate is. Now those are the three main things that you want to look at. That will help you identify the equity gap. What is the equity gap? The equity gap is the difference between what is owed versus sales price. Now, common sense will tell you that as long as the owner is making the mortgage payment, the equity gap is going to increase every month. And so you're going to have to stay on that. You're going to have to make sure that your client understands that you're going to, every month, around the middle of the month, you're going to ask them, hey, can you tell me what your new loan balance is? And you definitely are going to want to do that when you have an interested parties wanting to submit an offer on your assumption. So now you know what the equity gap is. Something else you're going to want to figure out is what is the, hold on, I'm going to start over with that. So now that you understand what the equity gap is, something else that you want to look out for, especially in my market, we're a heavy VA market just outside Fort Cavazos, you're going to want to make sure that you look at the taxes. You want to make sure that the seller of the property, if he is 100% disabled or if he isn't, you have to know that information, because if the seller is 100% disabled, when you ask the question of what their monthly mortgage payment is, you're going to have to make the adjustment to that to add in the taxes for a potential home buyer. The potential buyer may not be 100% disabled, and when they assume this loan, their mortgage payment will change. That could be a shock to them and could definitely lead to a unsatisfied home buyer who maybe you told them the mortgage was $1,600 a month. And now after the tax adjustment, it's $2,000 a month or $2,100 a month. That could actually hurt their ability to make that payment. Next thing you want to figure out is how long will it take for me to close this assumption, because that's going to help you guesstimate what that equity gap is going to be to prepare your buyer. Most cases, what we're finding out right now is that the assumption company or the current mortgage company is going to tell you that it could take 60 days to 90 days. We've seen some take as much as 6 months. Make sure that the consumer is prepared, and that is a question that you're going to want to ask the servicer, the mortgage servicer. Now, the first step in actually moving in the direction of closing a property on an assumption is having the seller get the contact information for the assumption department if there is one. And often it's not a phone number, it's not an actual person or point of contact, it's an email, i.e. assumptions@newres.com. And so once you have that information, the first thing you have to do is email and say, hey, I've got somebody that is interested in doing an assumption on this property. This is the loan number, so you're going to need to know the loan number. In the subject line, you'll put the property address, the loan number, and the word assumption. And then they'll come back to you and say, oh, this is all the information you're going to need. Now, you're going to get several VA forms that you're going to have to fill out. And if you've ever filled out VA documents before, you're going to understand it's a little painful. There's going to be some back and forth. That's okay. I've had some assumption deals that before we could even get to the point where we were writing the contract, we spent about a month going back and forth with the assumptions department on paperwork, everything they're going to need, releases from the seller. And keep in mind, in most cases nowadays, on a VA loan assumption, there is There is a requirement for closing cost. There is not the ability to do the assumption where the current owner keeps his VA certificate of eligibility attached to the property. Now they're doing what they call non-liability assumptions. And this is where the current owner will get his VA certificate of eligibility back, and the new consumer will have to use their VA certificate of eligibility. So again, on a VA assumption, it is now a requirement in most cases that the buyer be VA eligible. In the past, that was not always the case. It was always left up to the mortgage company if they wanted to allow a non-VA eligible purchaser to assume a VA loan. They can't do that anymore. In most cases, they're doing non-liability assumptions. Now that you have that information, one of the first things you're going to want to start to figure out, and this is the most complicated part of this, is what is it going to cost the buyer to purchase this house on assumption? So when the original purchaser bought the home, they had to pay what's called a VA funding fee. And those of you that are in the market or that have done VA loans, you understand this, you know what it is. Now on an assumption, you have to factor in 0.5% VA funding fee for the new buyer that has to be paid at closing, will not be rolled into the loan. Something else you're going to have to look at, the escrows. I don't mean the escrow money that goes to title for your buyer to purchase a home or to actually have a valid contract on the property. What I'm talking about is the escrow account that the current owner has their taxes and their insurance money going into. You cannot negotiate this. The companies have told me that they will not allow this to happen. That money has to go back to the current owner. That means that your buyer is going to have to establish their new escrow account, and depending on the time of the year, that could be several $1,000s. For example, you've got one here, property X. I know that my buyer is going to have to bring about $4,000 to the closing table just to cover the escrow balance, to replace what is moving out of the account. So you've got to look at that. So you have your VA funding fee, you have your escrows, and then you have another array of closing costs. Now, sometimes the assumption company isn't going to tell you up front what is needed to close. You're going to have to kind of work your knowledge of what it is going to take typically for a buyer to close on a home. On average, our guesstimate is that it's about $7,500. I've had agents tell me, well, hold on, I was told that it didn't cost anything to do an assumption, or these are no closing cost assumptions. Not really anymore. That's kind of a thing of the past. And so even when you look at the assumption guide for FHA and VA loans, it states that closing costs are required. And typically when you ask the assuming or the assumption department, what is this? They're going to tell you, it's only about $1,000. Maybe it's $1,500. What they're telling you is that's their fee that they're charging. You have to be prepared to, when you're putting all your numbers together, to roll that fee into the cost of the assumption. So now you have, let's just say $1,000. You have the assumption fee, you have the VA funding fee, you have the escrows, and you're still going to have all the other fees associated with it, to include title, escrow fees, because the rest of it is really going to look like a normal closing. The things that you don't have to worry about are an appraisal, a survey, a pest inspection. These items are off the table because of how the purchaser is buying the home. You can take those things away, but you'll still need title policy. In our market, typically that's covered by the seller. That's negotiated in the contract. And so you've got to make sure that you have prepared your buyer. Not only are they going to need the money for the equity gap, they're going to need the money for their closing cost. Now, again, in our market, and this is something that's just unique to us or unique to certain markets, especially military markets, the seller in most cases will agree or offer to pay all or some of the buyer's closing cost. As a listing agent on this, you have to keep that in mind when you run your net sheets, your example net sheets or your estimated net sheets for your client. Make sure to include closing costs in there. Like I said, for me, I always feel better putting about $7,500 to $9,000 in closing costs based on my experience with these and based on calling companies for my clients and asking these questions of their assumption coordinator. So now you have that down and you kind of understand that process. You want to get your forms filled out, get them turned in. Buyers sign parts of the form, sellers sign parts of the form. You get that stuff turned in. You present your offer at that point because you kind of have an understanding of what it's going to take to close this. And one of the biggest numbers that you're going to have to look at is that equity gap. In some markets, an equity gap of $20,000 or $30,000 is a lot of money, and in some markets, an equity gap, it may seem normal for a buyer to bring $100,000 to the table to cover the equity gap. You'll have to figure that out to kind of make sure that the buyer can meet all the parameters needed to close on this property. Now, figuring your equity gap, remember, please don't forget this. If it takes 4 months to close, the equity gap is higher. And you can look at an amortization schedule with your seller and kind of figure out or guesstimate what you think that's going to be. You have to take that into consideration. The amount of time, the burden that it's going to put on the seller and the buyer to make sure that they meet this. Because the worst thing that I can imagine happening is getting to the closing table and not having enough money for the buyer to abide by the contract to actually consummate the transaction. That becomes risky, something else you have to look at. And so just try your best to make sure that you have all your calculations in place. If you have any questions about that or need that, find an agent in your office or your broker that has done assumptions recently post-pandemic, and then they can help you put this together so that you understand what the assumption is going to look like. And I'm leaving out some of the other items. Like there is an assumption forms here in Texas that need to accompany the purchase offer. And so having said that, can a buyer borrow the equity gap? Well, based on what I've received from assumption departments is that all depends on the buyer. There's no set rule that says a buyer cannot borrow the equity gap. The problem will be is when can they close on that loan, basically a second lien on the property that's not before the purchase lien, of course. Can that close the same day? Does it need to close in advance? I've had some companies tell me that they needed that loan amount, that borrowed money to show up in the account 3 business days to 5 business days before closing. Just remember that that's something you put on your checklist if your borrower needs to borrow that money. If the client buying the property needs to borrow those funds, you kind of need to do your homework on that. Sometimes your client has the money. That's the easiest way. They already have the money. They don't need to look at a second that's going to affect their debt to income ratio, and it's going to kind of raise up some flags for the underwriter to say, hey, let me look at this and let me figure out if this buyer still qualifies having borrowed those funds. Next, you're going to have to look at if they don't want to borrow the money and they don't have the money, can they receive gift funds to cover the equity gap? And the answer is yes, typically, as long as all of the paperwork for the underwriter is correct. The gift letter, the forms. Sometimes the mortgage company wants to go in and they start looking at the person gifting the money. They want to see bank statements and make sure they understand where that money came from. And so hopefully this information has helped guide you through the assumption process. I know that depending on who you're talking to, which company, M&T, New Res, Mr. Cooper, whoever it is that you're working with, they're going to have specific documents that they want signed in a certain fashion. You're going to have to fill out, and they have their certain rules. And so it's always good to start off by trying to reach whoever it is the point of contact for their assumptions. Now, keep in mind, having said that, some banks, some mortgage holders do not have a dedicated assumption department, so it does get assigned to a loan officer that does assumptions as well as other loans, and so they'll educate you in the process. But the days of doing no money down or low money down assumptions is kind of out of the window. Just be prepared that the consumer is going to have some costs associated, just like in a traditional real estate transaction, for them to purchase the home on assumption. Assumptions are a great thing. You have a great interest rate. You can already tell what the mortgage is going to be. And a lot of times, you've got somebody that has like a 3% interest rate. They have a low equity gap. For me, the target for a viable assumption property is possibly somebody that bought during the pandemic because they paid a little bit more for the property, but maybe they got a 2.9 or a 3.5% interest rate. And so still that mortgage payment, that month-over-month mortgage payment, is affordable to the consumer. And so they're not necessarily focused on the sticker price. They're focused on what the cost is going to be with that rate month over month. And so those generally also have a lower equity gap. I had a call from a lady a few weeks ago that told me, hey, I'm selling a house in your market and we literally have no equity gap, or the equity gap, I think when I did the math, was not even $1,800. Boom. And they had a 3% interest rate. That makes it so easy when you have a cash poor buyer, as long as the seller is willing to cover the closing costs. And in this case, the seller was actually willing to pay up to $15,000 to help the buyer purchase the home in closing costs and anything else that went with that, maintenance, stuff like that. And so again, understanding what it takes to close an assumption, looking at it, making sure you stay current on the rules, because even here we're having this conversation, another servicer may have slightly different rules or a slightly different way of doing things. And so just be willing to ask the questions, look at it, and ideally you want to touch on that truth in lending and find out, can you send me a breakdown of all the fees that you are going to require or that you assume are going to be required to close this, so that I can look over it. You'll look at it. Typically Section C covers title fees. You know that you can kind of line through those things, X that out. You'll understand as an agent, hey, okay, so doing my calculation on prepaids and all these other fees that are associated with it, this is what it looks like it's going to cost my borrower to purchase this property. So again, thank you for your time. If you have any questions, leave us a comment, reach out to me. I'll have my email address attached to this, so that if you have any questions, you can shoot me an email. Again, my name is Rick Ott. Thank you so much for your time.